Between 1st August 2022 and July 11, 2024, the Nifty India Defence Index delivered mouth-watering 391% returns. Indeed, defence had turned into a hot theme and every investor wanted a piece of the pie. But then by February 18, 2025, the index had crashed by 38%. Investors looked at their falling stock just like Newton looked at the falling apple and realized the eternal truth. Which goes up ultimately comes down. However, this wasn't really an apple but a bouncy ball. The index again shot up smartly and touched a new high of 8,309 on 16 May. Now, the recent 4-day India-Pakistan conflict played a big role in this, bringing the defense sector back on investors' radar. Now, while the ceasefire agreement has been reached, Operation Sindoor is officially not over, and India has taken a tough stance against terrorism. Now, this can keep the defense sector in focus for the foreseeable future. Now, does that mean you should bet on the defense sector and stocks? Where does the sector stand after the recent run-up? What should you do if you already have defense stocks in your portfolio? Should you double down or should you pare your allocation? This video will provide you the answer to these questions. Hello and welcome to ET Money's YouTube channel. If you want to know a framework for picking defense stocks, we already have a video on that. I've included its link in the description. You can watch it later. Now, today's video is divided into three parts. In the first part, we will check the latest developments in the India's defense story to evaluate if it still enjoys tailwinds. In a previous video, which I had just mentioned, we discussed the broader picture of the Indian defense sector. For a more elaborate discussion, you can check that. Here, we will discuss the latest developments. In the second part, we will examine the valuations of the defense sector and its stocks. This will help us assess whether the sector and its stocks are cheap, expensive, or reasonably priced. Finally, in the third part, we will assess the recent performance of key defense stocks across financial and industry metrics. This will tell you how defense companies are doing financially. Now, this three-pronged exercise will give you a good idea of both the sector and individual stocks and hence help you make an informed decision. So, let's begin with revisiting the India's defense story. Since the Indian government is a major buyer of defense products, it makes sense to examine the budgetary allocation to defense in the Union budget for FY26. The government allocated 6.81 lakh crore for defense in the FY26 budget, a growth of about 10% over the previous year. Now, this rise in the defense budget shows the government's commitment to India's defense and hence the defense sector. Now, over the last 5 years, the defense budget has risen by a healthy 7.6% per annum. Apart from the government, exports are the second growth avenue for Indian defense companies. In FY25, the company's defense export rose 12% year-on-year to reach about 23,600 crores. Of this, the private sector accounted for 64% and defense PSUs contributed 36%. Now, the contribution of defense PSUs was up by a staggering 43% year-over-year, which suggests growing demand and acceptance of India's defense products globally. The Defense Minister, Mr. Rajnath Singh, recently said that India's defense exports have risen 34 times over the last 10 years. So, the export picture also remains robust for the defense sector. Finally, India has historically sped up its military spending after a war on an attack. This suggests that the hike in military spending next year can be even bigger, which will be good for the defense stock and sector. So, as far as India's defense story is concerned, it's not just intact but is growing great guns. That's a positive. Next, let's look at the valuations of the defense sector and individual stocks. To assess the valuations of the defense sectors, let's examine the valuations of the Nifty India Defence Index across three metrics: price to earnings, price to book, and dividend yield. The sector's current PE stands at 58 times. That's lower than the maximum of 73 times, but way higher than the minimum of 19 times. With respect to the median of 37 times, it's at a steep premium of 58%. Now, the sector's current PB is 14 times. Again, that's lower than the maximum PB and much higher than the minimum PB. Against the median of 8 times, it's at a premium of 76%, which is even steeper than the premium of the PE. Finally, in terms of dividend yield, the current yield of 0.46% is at a discount of 0.36 percentage points to the median yield of 0.82%. Now for dividend yield, a discount to the median suggests overvaluations and vice versa. So the index appears to be quite expensive across all three metrics. However, do note that the Nifty India Defence Index came into being only in January 2022. So we have data only since then. But that should not be problematic from an analytical standpoint, as the sector's prospects have also transformed only in the last few years. So very long-term average are of limited relevance. Still, to get an idea of the longer-term valuation picture, we can check the valuations of the top stocks of this index. The top 10 stocks of Nifty India Defence Index along with their index weights are on your screen. Let's check the valuation metrics of these 10 stocks. The first observation about the valuation numbers is that they are very high in absolute terms. The PE numbers range from 40 to 120 times and the PB numbers range from 5.5 to 29 times. The second observation is that even when compared to historic medians, the numbers remain pretty high. We've also mentioned PE to earnings growth or PEG numbers. The PEG ratio is especially used for high growth stocks. It compares a stock's PE ratio with its earning growth rate. A PEG of less than 1 is considered a bargain, and that of more than 2 indicates overvaluation. Now most stocks are currently trading above 2, so they appear to be expensive in terms of PEG as well. Overall, valuations of defense stocks and the index are quite pricey at the moment, and it appears that a lot of optimism is already baked in. Finally, let's check the recent performance and some relevant industry metrics of defense stocks. But before that, if you're finding this video useful, do subscribe to the channel and don't forget to press the bell icon so you never miss a video from us. Alright, first let's take a look at the recent performance at the index level. An interesting picture emerges here. The median business performance of index constituents has improved in the latest quarter as compared to the last 2 quarters. However, it has yet to reach the levels 3 quarters ago. Now, how have the top stocks performed during the latest quarter? The companies that have particularly done well include Bharat Electronics, Solar Industries, Mazagon Dock Shipbuilders, and Zen Technologies. These companies have witnessed a rise in their revenue and profit, and their operating margins have expanded too. But apart from these mainstream business metrics, there are certain other metrics that matter in defense companies. The first of them is an order book. Since defense companies are essentially manufacturers, their order book can provide a good visibility of their revenues. As mentioned in the table on your screen, top defense companies have multi-year revenue visibility as far as their order books are concerned. Of course, this is not to say that the full order book will convert into revenues, but it still does provide a good idea. The next important metric for defense companies is their cash flows. Because defense is a B2G type of business with a long gestation period, its cash flows tend to be lumpy. The payments from governments can be delayed, and that can result in cash flow problems with defense companies. A persistent cash flow problem can escalate to high debt levels or equity dilution, and hence it can affect companies' performance and shareholders' returns. Let's check the cash flow positions of the top companies in the sector versus their profits. Now, because the cash flow statement is released twice a year, here we will compare the cash flows for the last 4 6-month periods with the profits of those periods. Ideally, cash flow from operations or CFO to PAT ratio should be 100% or more. This indicates that the company has converted all of its accounting profits into real cash. If not 100% or more, it should be at least be over 80%. Now, except for 2 companies, Hindustan Aeronautics and Solar Industries, most top defense companies' cash flow to PAT ratios remain subdued or negative. BEML's high CFO to PAT in the latest 6-month period is because of both negative cash flows and losses. So don't be carried away by that. Hindustan Aeronautics and Solar Industries have in fact generated free cash flow over the last 4 6-month periods as well. Now, free cash flows are cash flows from operations minus capex. They indicate the excess cash a company is left with after spending money on operations and capital investments. In other words, free cash flow is the money that can be taken out from the business without impacting it. Free cash flows can be used to pay dividends or buy back stocks or for expansion. So, free cash flows signal business strength, more so for capital intensive manufacturing oriented businesses. Alright, so let's summarize the key takeaways of this video in the concluding section. As a theme, defense does enjoy positive tailwinds. After the latest India-Pakistan conflict, it's also likely that defense spending and budget will be boosted. This will surely help defense companies. After Operation Sindoor, India's defense equipment has also gained currency the world over. This will also benefit Indian defense companies. However, valuation-wise, not much seems to have been left on the table for investors. The defense index and leading defense stocks are flashing red in terms of valuations. As far as the recent performance is concerned, solid order books are a plus, but without sound cash flows, defense companies' profits seem to be on a weak footing. But two companies, Hindustan Aeronautics and Solar Industries, stand out. You can take a look at them, but don't forget to do your own research. Do note that these are not our recommendations. Of course, there are many other listed defense companies that we haven't covered in this video. It's likely that there are promising options among them as well. If you would like to, you can analyze them the way we have done this video to assess their attractiveness. You can also watch our previous video on defense stocks, which I mentioned at the start of this video. Do let us know your views on defense stock and whether you would like to have or already placed your bets on it. This is all I had for you today. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.